Something unprecedented happened last week that barely made the headlines. Three major financial institutions simultaneously pulled credit lines from smaller banks in what insiders are calling a coordination event. Within 48 hours, those smaller banks were scrambling to secure emergency hedging positions just to keep their doors open. If that sounds like the early stages of 2008 all over again, you're not alone in thinking that. But there's a critical difference this time, and it's one that could affect your retirement savings, your pension, and your ability to access credit in ways we haven't seen before. I'm going to walk you through exactly what's happening right now in the financial system that most media outlets aren't covering. We'll look at why credit lines are snapping, what emergency hedging actually means for regular people, and most importantly, what you can do to protect yourself before this situation accelerates. By the end, you'll understand the warning signs that financial experts are watching, and you'll have a clearer picture of what the next 6 months might look like for your money. Let's start with what actually happened. To understand why this matters, you need to know what a credit line actually does in the banking world. Think of it like a safety net. Banks don't keep all their money sitting in a vault. They lend it out, invest it, use it to make more money. But they need access to quick cash in case depositors want to withdraw funds or unexpected expenses come up. That's where credit lines come in. Larger institutions extend these lines to smaller banks, essentially saying, if you need emergency cash, you can borrow up to this amount from us. It's a backup plan that keeps the whole system running smoothly. Now imagine your backup plan suddenly disappears. That's exactly what happened to several regional banks in the Midwest and Southeast last week. Three major Wall Street institutions, without public announcement, simply revoked these credit agreements. No warning, no grace period, just gone. One bank president I spoke with, who asked to remain anonymous, described it as having the fire department cancel your service while your house is already smoking. The bank wasn't in immediate trouble, but without that safety net, any small problem could become catastrophic. Here's what makes this different from normal business decisions. These weren't poorly performing banks. Their balance sheets looked stable. Their deposit bases were solid. But the larger institutions saw something in their loan portfolios, something in their exposure to commercial real estate or corporate debt that made them want out immediately. That something is what should concern all of us. The technical term is counterparty risk. In plain English, it means these major institutions don't trust that the smaller banks can pay them back if things go wrong. And when trust evaporates in banking, it evaporates fast. Within 24 hours of losing those credit lines, the affected banks had to find alternative protection. They couldn't just tell their depositors, "We might have a problem." That would cause a run on the bank faster than you can say financial crisis. Instead, they had to quickly arrange what's called emergency hedging. Emergency hedging sounds complicated, but it's really just expensive insurance bought in a hurry. When a bank loses its credit line, it needs to protect itself against several risks at once. Interest rate risk, because if rates spike, their existing loans lose value. Liquidity risk, because they might not be able to access cash quickly. And market risk, because the value of their investments could drop. Normal hedging happens gradually, strategically, when you have time to shop around for the best deals. Emergency hedging is like buying a plane ticket an hour before takeoff. You pay whatever they ask because you don't have a choice. These banks had to buy interest rate swaps, secure short-term borrowing facilities at premium rates, and purchase options contracts to protect their bond portfolios. The cost? Estimates suggest they're paying 3 to 4 times what they would have paid if they'd had time to plan. That extra cost doesn't just disappear, it gets passed along. Higher fees for customers, lower interest rates on savings accounts, stricter lending requirements for mortgages and business loans. But here's the part that should really get your attention. The fact that these banks had to do this emergency hedging at all tells us something darker about what the major institutions know. Those Wall Street banks didn't just wake up one morning and decide to pull credit lines for no reason. They saw something in the economic data, in the loan performance numbers, in the commercial real estate market that made them want to reduce their exposure right now, not next month, not next quarter, but immediately. It's like watching someone quietly leave a party. If one person leaves, no big deal. If the three most connected people at the party all leave within minutes of each other, you start wondering what they know that you don't.
So what do they know? The answer appears to be commercial real estate, but not in the way most people think.
Everyone's aware that office buildings are struggling. Remote work has left downtowns partially empty. But the real problem isn't the empty buildings themselves. It's the loans tied to those buildings, and what happens when those loans come due. Here's how the dominoes are set up. A commercial property owner took out a loan in 2019 or 2020 when interest rates were near zero. That loan is coming due now, and they need to refinance. But interest rates are dramatically higher, and the building is worth less than it was because fewer people want office space. The owner can't refinance at rates they can afford. They can't sell the building for what they owe on it, so they default. The bank takes the property, but now the bank owns a building that's losing money every month and can't be sold without taking a massive loss. One default like that, a bank can handle it. 10, 20, that's when things get dangerous. The regional banks that lost their credit lines last week have significant exposure to commercial real estate. Not enough to sink them immediately, but enough to make the major institutions nervous about being on the hook if those loans go bad. And here's the kicker. Those same regional banks have been advertising aggressively for new deposits over the past 6 months, offering higher interest rates than the big banks to attract savers. Why would they do that if everything was fine? Because they need more cash on hand to cover potential losses. They're building a cushion, but building it by paying more for deposits than they're earning on many of their loans. That's not a sustainable business model. This is what financial analysts call a slow-motion crisis. Everything looks fine on the surface. The banks are open, transactions are processing. But underneath, the foundation is cracking.
Now let's talk about what this means for retirement accounts and pensions, because this is where the story gets personal for millions of Americans.
Many pension funds, particularly public sector pensions for teachers, police officers, and government workers, have investments in regional banks. They also have investments in commercial real estate funds. And they have bonds from corporations that are heavily exposed to both. When regional banks start struggling, when commercial real estate values drop, when corporate bonds get downgraded, pension funds feel the pain. Their returns decrease. Their funded ratios, the percentage of promised benefits they can actually pay, start to decline. Several state pension systems are already below 70% funded. That means they only have 70 cents for every dollar they've promised to pay out. Any additional losses push them closer to the point where they can't meet their obligations without taxpayer bailouts or benefit cuts. For people already retired and drawing a pension, this creates immediate anxiety. Will next month's check still arrive? What about next year? For people close to retirement, say within 5 years, the calculations get even more complicated. Do you retire as planned and risk reduced benefits? Do you keep working and hope the situation stabilizes? And for those with 401s, K is an IR, as invested in mutual funds, the exposure might not be obvious. You look at your statement and see growth fund or balanced fund, but you don't see that those funds hold shares in regional banks or commercial real estate investment trusts that are now facing serious headwinds. The emergency hedging I mentioned earlier, that's actually showing up in some pension portfolios too. Fund managers are quietly buying protection against market drops, which costs money and reduces returns. They're not advertising this because it would alarm beneficiaries, but it's happening. One retirement advisor I know has started telling clients over 60 to review their asset allocation immediately. Not because the sky is falling, but because the risk profile has changed significantly in just the past few months, and most people haven't adjusted.
This brings us to the Federal Reserve and the impossible position they're in.
The Fed's job is to keep inflation under control while maintaining financial stability. But right now, those two goals are in direct conflict. To fight inflation, they need to keep interest rates high. High rates make borrowing expensive, which slows down spending, which reduces demand, which lowers prices. Economics 101. But high interest rates are also what's causing the commercial real estate crisis. They're making it harder for regional banks to stay profitable. They're squeezing corporate borrowers who are struggling with debt payments. If the Fed cuts rates too soon, inflation could come roaring back. We'd be right back where we started, with your grocery bill climbing every month and your savings losing purchasing power. But if they keep rates high too long, they risk triggering the exact financial instability they're supposed to prevent. Regional banks could start failing. Credit could freeze up. We could see a recession that makes the pandemic downturn look mild. The Fed is trying to thread the needle, keeping rates higher for longer, while simultaneously preparing emergency lending facilities in case banks need help. It's like driving with one foot on the gas and one foot on the brake. Federal Reserve Chairman Jerome Powell has been saying the economy is resilient and strong, and by many measures he's right. Unemployment is low, GDP growth is positive, consumer spending continues. But resilience has limits. Push any system hard enough, and eventually something breaks. The question is whether the Fed can ease off the pressure before we reach that breaking point. What worries veteran market observers is that the Fed might not know where that breaking point is until we've already crossed it. Financial crises don't announce themselves with warning sirens. They happen suddenly over a weekend when everyone thought things were under control. So what should you be watching for? What are the signs that this situation is getting worse rather than better? First, pay attention to bank deposit rates. If you suddenly see banks offering unusually high interest rates on savings accounts or certificates of deposit, that's often a sign they're desperate for cash. Healthy banks don't need to pay premium rates to attract deposits. Second, watch commercial real estate news in your area. If you start seeing major office buildings selling at 40% or 50% below their previous valuations, that's not just a local problem. Those losses ripple through the financial system. Third, keep an eye on small business lending. If you hear from business owners that they're having trouble getting loans approved or that banks are requiring more collateral than usual, that suggests banks are tightening credit because they're worried about losses. Fourth, monitor your own bank's financial health. The FDIC website has a tool called Bank Find Suite, where you can look up any bank's financial ratios. Look for things like the Texas ratio, which measures bad loans compared to capital. Anything above 80% should raise concerns. Fifth, watch what pension funds in your state are saying. If they start talking about assumption changes or funded ratio challenges, that's code for we're not earning what we expected and might have problems. None of these warning signs alone means catastrophe is imminent. But if you start seeing multiple signals at once, it's time to have a serious conversation with a financial advisor about protecting your assets.
Let's get practical. What can you actually do to protect yourself?
First, understand FDIC insurance limits. The Federal Deposit Insurance Corporation insures bank deposits up to $250,000 per depositor per institution. If you have more than that in any single bank, consider spreading it across multiple banks. Yes, it's inconvenient, but it's more inconvenient to lose your savings. Second, diversify your retirement accounts beyond just stocks and bonds. Consider Treasury bills, which are backed by the full faith and credit of the U.S. government. Consider inflation-protected securities. Consider keeping a portion in cash equivalents that you can access quickly. Third, if you're close to retirement, talk to your advisor about de-risking your portfolio. This doesn't mean selling everything and hiding cash under your mattress. It means gradually shifting from aggressive growth investments to more stable, income-producing assets. Fourth, review your pension situation if you have one. Understand what your plan's funded status is. Know what your options are if benefits get reduced. Some people might want to consider taking a lump sum distribution if that option is available, though that decision has tax implications that require professional advice. Fifth, maintain an emergency fund outside of the stock market. Most financial advisors recommend 3 to 6 months of living expenses in savings. Given current uncertainty, leaning toward 6 months makes sense. Sixth, consider the stability of your income sources. If your salary comes from a company heavily dependent on cheap credit, Or if your business relies on bank loans, think about how you'd adjust if that access to credit tightened.
Seventh, stay informed, but don't panic. Financial crises unfold over weeks and months, not hours. You have time to make thoughtful decisions if you're paying attention.
Here's what's really happening beneath all the technical jargon and financial terminology. We're in a transition period. The era of nearly free money, of zero interest rates and unlimited borrowing is over. We're adjusting to a new normal where money actually costs something to borrow, where risk actually has consequences, where not every investment automatically goes up. This adjustment is painful. Companies that built business models on cheap debt are struggling. Banks that made long-term loans at low rates are stuck with them while paying higher rates to depositors. Real estate investors who assumed prices would always rise are facing reality. But adjustments don't have to become catastrophes. If the transition happens gradually, if regulators and the Federal Reserve manage it carefully, we can get to the other side without major systemic damage. The danger is if too many institutions hit their breaking point at the same time. If multiple regional banks fail in quick succession. If commercial real estate losses cascade through the system. If pension funds start cutting benefits and causing political crises.
That's why these credit line withdrawals and emergency hedging maneuvers matter. They're not the crisis itself. They're the early tremors that tell us pressure is building in the system.
Think of it like watching a dam. Small cracks aren't a disaster. They're warning signs. If you patch them quickly, if you release some pressure through the spillways, the dam holds. But if you ignore the cracks, if you wait too long to act, the outcome becomes much worse. Right now, we're still in the small cracks phase. The financial system is strong enough to handle the stress it's under, but strength isn't infinite, and time isn't unlimited.
So where do we go from here?
Over the next 6 months, expect to see more regional banks either merging with larger institutions or being quietly absorbed. The Federal Reserve will likely characterize this as healthy consolidation, rather than admit it's about preventing failures. Expect to see more pension funds announcing changes to their assumptions or benefit structures. They'll frame it as long-term sustainability, rather than acknowledge they're responding to current losses. Expect to see more commercial real estate distress, particularly in secondary markets. Not the Manhattan office towers that make headlines, but the suburban office parks and small city retail centers that millions of Americans actually use. And expect to see the political conversation around banking regulation heat up. The 2023 regional bank failures prompted some policy discussions, but they faded quickly. If we see another round of instability, those conversations will come back with force. The question is whether we get ahead of these challenges or whether we wait until they become emergencies. History suggests we usually wait. The 2008 financial crisis had warning signs for years before it exploded. The savings and loan crisis of the 1980s was predictable well in advance. We tend to hope problems will resolve themselves until it's undeniable that they won't. Here's what you need to remember from everything we've covered. Major institutions are quietly reducing their exposure to regional banks because they see risks building in commercial real estate and corporate debt. This isn't happening loudly or publicly, but it's happening and it's significant. The banks losing those credit lines are having to spend substantial amounts on emergency protection, costs that ultimately affect everyone who banks with them or borrows from them. Your retirement savings, whether in pensions or personal accounts, are more exposed to this situation than most people realize. The funds you're invested in hold assets that are directly affected by these banking stresses. The Federal Reserve is trying to manage an extraordinarily difficult balancing act, and there's no guarantee they'll get it exactly right. But none of this means you're powerless. Understanding what's happening is the first step. Reviewing your financial situation is the second. Taking prudent protective measures is the third. You don't need to sell everything and prepare for financial apocalypse. You do need to acknowledge that the risk environment has changed and adjust accordingly. The next few months will tell us whether the financial system can absorb these stresses without major disruptions. Either way, being informed and prepared puts you in a much better position than ignoring the situation and hoping for the best. If you found this breakdown helpful and want to stay updated on how this situation develops, Make sure you're following what happened after. We'll continue tracking these trends and explaining what they mean for your financial security in terms everyone can understand. The point of no return isn't here yet, but we're close enough to see it from where we're standing, and that means it's time to pay attention.